And we are live. What's going on, guys? It's Ricky with TechBud Solutions here with another live stream. Today, we are going to be watching the market react to the FOMC rate decision. This is going to happen in less than 4 minutes, 3 minutes and 5 seconds from right now. For those that have never tuned on in, just give us a few seconds. We're just going to make sure everyone is getting into the live stream nicely, and once we're all here and you guys can see me, we can go ahead and jump right into it. I can break it all down for you guys. We are live, posting it right now via Discord. Again, a friendly reminder, I do trade live every single morning at market open with our LPP team. I'm sure a lot of you guys have already heard me talk about it before, but again, if you ever want to check it out and you want to tune on into these live sessions, it's the second link in the description down below. We have a little discount link there for you. So fresh cut. I literally just got back. I went to my barber and I was like, hey, I need to be done before 11 o'clock. So I'm happy to be here. Thank you guys again for dropping so much love and support on the channel. I'm happy to see that a lot of you guys wanted me to go live. And I'm very excited to see how the market actually trades. If you tuned on into today's live trading session, again, we kind of talked about what to kind of expect. Markets have been kind of trading lower, but not by much, right? The big move happened during the pre-market session, and that was due to the PPI report. What we're looking for right now is this FOMC rate decision. In the next 2 minutes, the Federal Reserve is expected to pause. According to the Fed Rate Monitor tool, which is, again, just the probability tool, it's never 100% guaranteed, but there is supposedly a 100% probability that the Federal Reserve is going to pause interest rates, meaning that they're not going to cut, they're not going to raise interest rates. They're expected to pause. Markets want interest rates to be cut, but there's only one interest rate cut projected for 2026. So, again, do with that information as you please. But nonetheless, we're here. We're waiting for the market to react. We have 1 minute and 10 seconds left. You guys ready? Are we all ready for the rate decision? So what are some steps you can take before the rate decision is announced? If you have an aggressive position, if you're over leveraged with a very large position, you can do something about it now or expose yourself to the volatility that presents itself after. It's never ideal for beginners to take large positions before a major economic report. It's just my 2 cents. That's from my experience. If you want to, at the end of the day, you're an adult. You can do whatever it is that you want. Here we go. 30 seconds left. Okay. All right. Let's see it. Okay. Good afternoon. Good afternoon. Yeah. Beautiful start to the day. We are cooking. 0 chance for a rate cut. Here it goes. 2, 3, 2, 1. Boom. Again, markets are always looking for a reason to rally. Let's see how they actually trade. We saw a pretty dramatic move due to the PPI report. Let's see if we see another dramatic move. I want to remind you that this is the rate decision, which is pretty much expected, right? And then there's the press conference. There are 2 different waves of either buying pressure or selling pressure. Just because maybe markets sell off or push up right now doesn't mean that that's how they have to continue during the press conference, right? So just want to make sure that we're all aware. Any big change? No, to my understanding, with how markets are reacting, it's what was expected. Here we go. FOMC rate decision. Yep, 3.75%. No change. Okay. Now this should reset. Yep, there it goes. And this was the PPI report this morning. All right, looks like NASDAQ market is trying to go back up. It looks like it's trying to test the pre-market support range. Not very surprised. Again, markets will do anything in the short term to try to look bullish. But if you zoom out, especially if you've been paying attention to news, Nothing about this current market is bullish. Nothing, right? There's nothing that's thriving. Things are not getting better in the Middle East. I'm not trying to be a negative Nancy. I'm just shedding light on the truth, right? Things are uncertain, and that's why markets reacted the way that they did during the pre-market session. So I wanted to ask you guys, we're all good to continue the live stream for the press conference, right? In about 28 minutes, Jerome Powell is supposed to go live and begin to answer analyst questions. Would you guys like me to stay live? Yeah. For all those that are tuning on in late, there was no change for the FOMC rate decision. What was reported, forecast, and actual. We're all good? You guys know what I'm going to ask you. If it's not too much to ask, all I ask you to do is to drop a thumbs up on this live stream. And if you have any questions, of course, just partake in the live chat, which you do have to be subscribed to the YouTube channel for. Here we go. NASDAQ market, slight rejection, nothing new. Markets have been consolidating this entire session. I thumbed you up already. Okay, there we go. All right. We're all good. Okay. For the meantime, I mean, we have 27 minutes to spare. Do we want to break down some stocks? You guys want, let's make the most of it, right? We have to wait for Jerome Powell to go live. That's not going to happen until the next 27 minutes. You guys want to share some tickers in the live chat? And I can break it down for you. We all good with that? Let's kill some time. Yeah? All right, let's do it. Again, I really hope that you guys learned something new. And if you do, all we ask you to do is to drop a thumbs up. Markets are consolidating right now. I think the market overall is just really waiting for Jerome Powell to speak and to see what his tone is. If he makes any comments on especially what's going on in the Middle East, I find it very hard to believe if he would, but if he does, how markets would react to that, right? They seem to be very sensitive right now. All right, let's do it. Wow. A lot of you guys want me to break down stocks. Let's do it. Okay. When I break down these different stocks, we're not going to just be looking at them on the technicals. We're also going to be looking at them on the fundamental side. So I'm going to be using this software from Investing Pro. I do want to let you guys know that they do have a sale going on. Let me refresh it, making sure that it's still valid. 22 hours is what you have left to claim 55% off. It breaks down to less than $9 a month. Again, you don't have to take advantage of the sale if you like paying full price. But if you like the software, just know that you can get it right now for the next 22 hours for 55% off. Let's go ahead and jump right into it. So first one is, I see it popping up right now, MU, which is Micron Technologies, if I'm not mistaken. Looking at Micron Technologies, when we look at it on the larger time frame, again, incredibly bullish. Well, what's your question? Are you thinking about going long on this? Like, do I view this to be a really good deal? Of course not. But it is a stock that is doing exceptionally well, kind of during an uncertain time, right? Higher highs, higher lows. It's at a $500 billion market cap. Is this overbought? Now, just because it might be overbought doesn't mean that it would make sense to short it. I would not care to short this by any means. Yeah, it's a little bit on the overextended side, but it's so incredibly bullish and resilient over a long period of time that it's just, there's so many bullshit companies out there that are so much easier to short. Why would I waste my time, my energy, and my money on something like Micron when it's just so bullish, right? Let's look at it on the fundamental side. If we look at Micron Technologies, it looks like there's 21% of potential downside based off of fair value from 39 different analysts. Net income is expected to grow this year. Analysts anticipate sales growth from the current year. 8 analysts have revised their earnings upwards for the up and coming period, and it trades relatively at a low P ratio. I wouldn't say that's a low P ratio. That's 44.1 times its earnings. It is a company that produces $42 billion in revenue, $11.9 billion in net income. That actually is pretty impressive. And it's growing. Wow. Okay. Now, again, out of all stocks we're able to short, this definitely would not be at the top of my list. I could see why someone would be invested in this, especially, I mean, if I'm not mistaken, Micron Technologies actually has a huge facility out here in Arizona. So I have heard about them, but not with this much momentum. I remember when they were kind of struggling. Was that not the case? This thing was trading at lows of what, $62 per share, and now trading at 471. So I do see why people are kind of maybe like, hey, this thing rallied very aggressively within a very short period of time, but it looks like its revenue is just growing exceptionally as well. Micron is experiencing extraordinary momentum driven by AI infrastructure expansion, with fiscal Q1 revenue reaching $13.6 billion, up 57% year over year. Gross margins are expanding to 56%. Like, this is not just an aggressively growing business year over year, revenue wise, but also it has huge margins. Posted record free cash flow of $3.9 billion. This is what Opendoor wish it was. Opendoor is like, I don't know how else to describe it other than a house flipper that's valued as a tech company, right? An AI-driven tech company. There's nothing AI about it. It's Opendoor is all about, razor thin margins, and that was even during an exceptional bullish housing market. Now housing is getting weaker. So I think this is a really good example of companies that I could see why people are investing into the story of Micron, because not only do they talk the talk, but they walk the walk, right? It's doing exceptionally well. Growth is there. It's not just an opinion, it's a fact. Its revenue is directly correlated to the actual price performance itself. Very impressive. I'm actually, again, I can admire it from afar. I would say it's pretty safe to say that I missed the boat on this one. It's done exceptionally well within a short period of time. It's just not a good enough deal, and it's trading at a decent premium that if things do begin to correct, this thing can begin to see potential downside. But again, in no way would I ever care to short a stock like this by any means. Not at all. All right, let's go ahead and move on to the next one. APLD. Okay. Applied Digital. Looks like it was bullish. Recent retracement on the day time frame, 4-hour time frame. We're seeing a lot of consolidation, lack of direction. I would keep it pretty simple with this. I would set an alert for the break above and alert for the break below. There's just no other reason to support anything. Like, I don't want to waste time as something consolidates. It's not bullish, it's not bearish, and it just recently pulled on back, and we just don't know which way it's going. If you're so certain that it's going to go up, then again, be my guest. But nonetheless, if you're uncertain and you can see that lower highs and lower lows are presenting themselves, things are becoming a little bit more uncertain, then that's where you want to be careful, right? And that's why we wait for confirmation, APLD. Let's go ahead and look at this. So Applied Digital currently sees 26.4% more downside based off of 11 analyst target to $45. Trades at a negative 70.5 times its earnings and a net income of negative 121 million. Again, this just isn't going to be the stock that I would feel comfortable investing in. Just because I don't doesn't mean that you shouldn't, right? We could all see value in different ways. There's people that have, much higher risk tolerance than me. But however, significant financial challenges persist. Applied carries $2.6 billion in total debt with negative leverage free cash. Yeah, I would be out with that. To be trading at an insane premium at these elevated levels during such an uncertain time, if things actually do get worse, these are always the companies that crash the hardest. I would fully just not partake in any of this at all. Ban the spammers in here. There's a lot of people that are commenting. My apologies. I can't see all the comments right now. So I think everyone's just asking for me to break down their stock. So it's fine. Here we go. We got Abraham asking for ASTS. Let's go ahead and break it down. ASTS. Again, Abraham, I appreciate you tuning on into this live stream. Looks incredibly bullish. Higher highs, higher lows. Man, that is some insane growth. 4-hour time frame. Like, does this look like an incredible deal to me? No. It looks more of like a momentum play, being able to, buy the lows and sell the rips. I would imagine with the way that it's trading, It's going to be pretty speculative. Let's see, ASTS. Okay, 8% downside. Currently loses $461 million in net income, negative ADP ratio. Again, you can see value in this without me needing to. I can just tell with the way that it was trading that it was pretty speculative. When you see insane growth with huge rip ups and then huge rip downs, huge rallies with huge corrections, again, there's money to be made. Direction is in your favor. My issue with this is that during uncertain times, remember, this was all rallying as market conditions were bullish. Now things are maybe a little bit more uncertain. And if we do experience a downturn, then these companies are the ones that fall the hardest. But if you believe that we are only going to go higher for the overall markets, then that does support the case on why you would want to consider going long on this. And again, I respect that, right? From current lows to previous highs, yep, 34% of potential upside. Obviously, I see there to be a decent amount of downside as well. If we look at previous lows, it's about 20%. If it breaks below the moving average, another 30%. So it is an ascending uptrend pattern. As long as the pattern stays true, then I think that's what matters most. If this thing begins to curl on over, break support, and begins to form lower lows and lower highs, to me, that would be a break of structure, a break of pattern, and I would fully get out of that position, especially knowing fundamentally it's just not doing well, right? It's a company that blows and burns through so much money and has an insane valuation based off of current performance. And to me, that's a red flag during an uncertain time. All right, let's move on to the next one. I like Tesla. Okay, that's what someone said in the live chat. Tesla's an interesting one because if you actually pay attention to, this is where it's kind of like the debate. Now, again, don't get me wrong. I love Elon. I love my Teslas that I own. I have a Cybertruck and I have a Model X Plaid. I love them. They depreciate like no other, but I love them. Tesla as a car company is not doing good. Again, you wouldn't really be able to tell based off of its price performance and even due to recent retracement. That's nothing. Tesla is trading at an insane valuation. And if it wasn't because of Elon, it would never sustain these levels. There's 30% downside based off of 41 analysts, 393 times its earnings. It's the most overvalued and expensive company to own. That's part of the Magnificent Seven. It's a company that is valued at, this is the part that's hard for me to make sense of. It's a company with a $1.5 trillion market cap. That's with a T, 1.5 trillion. But it's a company that produces less than $4 billion in net income. If we look into Tesla's performance, again, I get it. It's not just the car company. But look at its revenue. It's no longer growing. And it's not like it's just been recent. It hasn't been growing since 2023. We're in 2026 now. Oh, but Ricky, they're coming out with the Optimus robot. Oh, but Ricky, what about the SpaceX valuation? Trust me. I've heard the stories. I get it. That's what is really carrying Tesla and allowing it to trade at these levels. It's the hope. And there's no one really else that we can hope on more than Elon. Is Tesla a good deal at $400? No. If it pays off with SpaceX and with the Optimus robot, could it be worth it to invest in Tesla here? Possibly. So that is where you have to decide. And that's, I would say, the challenging part, because all the other Mag 7 stocks are pretty straightforward when it comes down to their valuation. They have their guidance, they have what they're currently producing as a company, and what they're projected to produce, right? It's pretty straightforward. We know NVIDIA is a juggernaut of a company. They just announced an amazing 2027 of what they expect to produce. There's a reason it's the most valuable company that's publicly traded. But Tesla is a little bit more of a dreamer's story. There's nothing wrong with that if you can tolerate the downturn, if things do get worse before they get better. And I think that's, what I want to shed light on is sometimes I think I talk too much about it just based off of my perspective of like, no, Tesla is not a growing company. It's not worth this. But I could see the story on why it might be worth it for others if they believe the SpaceX and Optimus robot story. And that's what I would say to you, is that if you're so certain, then be my guest. I just wanted you to be aware of the pretty premium that you're paying right now. 393 times of what the company produces is what you're paying for its current valuation. So if SpaceX and Optimus doesn't pan out the way that Elon Musk has commented on, then again, there's a lot more downside to come, right? But obviously if it does, maybe Tesla does hit a 5, maybe $10 trillion market cap, as that is what Elon Musk has said himself. I believe he said that the Optimus robot, and he said this many years ago as well, that the Optimus robot will be the #1 selling consumer product ever in this world. And he said it won't even be close. Trust me, that's a bold statement, but it's an attractive one. And I can see why people are attracted to that. And I respect your opinion 100% to invest in it if that's what you align with. I just want you to be aware of the risk. I'm not here to turn you away from investing in Tesla. I just wanted you to be aware. That's all we're here to do, right? Not to tell you, but to inform you of both sides. All right, let's go ahead, and I like that one. Where is it? Nike. This has been one that we've joked around about in our LPP live trading. A lot of you guys know that, for those that don't, I have a daughter, right? And I have my son. And I talk to my LPP team about it more, just because we have open conversations kind of like this every morning. And one of the conversations that we've been having lately is, Nike's a household name, but man, look at the stock. It's been selling off since 2021, the end of 2021. We had an amazing rally, currently at $52 to almost $53 per share. What is that? You are buying Nike at the same level and same valuation that it was in 2016. But what do you think is being said in the back of my head every time? Because I'm thinking about, okay, what do I want to invest in? I don't see Nike as a trade. It's not lucrative enough. It's not volatile enough. It's none of that. My thing is, if we pull up Nike and where it's currently at, there's huge upside according to analysts. Honestly, its P ratio is not even that attractive. $2.5 billion in net income, $46 billion in overall revenue. Its valuation for its market cap, its market cap is low based off of current valuation. It's down almost, 70%? 67%. So that's the thing, is that a lot of people are commenting like Nike is a fading brand. But do we actually believe that? Like, is that actually true? When we look at Nike and we look at what it's producing, it's not a growing company. Net income plummeted 32% year over year. There's a lot of that due to the tariffs. There's a lot of that due to the tensions between the US and China, because a lot of the manufacturing is done overseas. And is that likely to get better? Or will it get worse? Right? Obviously, that affects the overall spread, the fees when it comes down to these companies. If we look at their overall flow chart for the LTM models, we could see that year over year, again, cost of goods are incredibly expensive. When we look at it quarter after quarter, nothing is growing aggressively like it once was. So I do see both sides. It once was an aggressively growing company, but things have began to fade. But then it also takes me back to the idea of, what about what Warren Buffett says? Buy when others are fearful and sell when others are greedy. You know, for my daughter that's 4 or my son that's 5 months, you know, would buying a few shares down here be something that could be worth their while if I just buy a small amount for them, right? $5,000 or $10,000, and they hold it for, you know, 15 to 20 years. Would it pay off then? These are the conversations that I love having with myself, my financial advisor, and also our team, because it really gets you to ask those questions of, you know, Nike's not a fancy tech company. It's not a fancy AI trying to revolutionize alternative energy. It's just a household name, but it is a good business. It's just a business that's currently struggling. So do you believe enough in the brand that it could recover? Again, I love talking about things like this, not because they have to make anyone any money, but I feel like, again, while everyone is only focused on tech, I think things like this, to be able to talk about them when they're not looking so hot, it at least allows us to like entertain that conversation. So just wanted to have that conversation with you guys. So I definitely do like Nike just because of the name and what it once was. I do see why investors are not super enthusiastic due to current geopolitical issues and also due to current revenue lack of growth, right? It all makes sense. It really does. All right. This is one that I have in my, I thought I did. I have it in my oversold watch list, and it's one that I still want to entertain to possibly go long on, but we all know that the cheap can always get cheaper. So it's been cheap a year ago, a year before that, and it just keeps dropping, right? So who's to say this can't drop another 50%? And that's the problem. Okay. No, I'm good. Thank you. I'm good. Ricky, can you please do an update on Open? I don't want to talk too bad about this company on my, just kidding, let's do it. Just kidding. Yeah, I'm not a fan of Open by any means. I think any company that goes from 50 cents to $10, again, it's the meme stock movement. There's an Open army. Honestly, I think I spend too much time poking fun where I sometimes almost even feel bad for these people. Because it's the same story over and over again. They always think that this time it's different. You know, what has recently happened to AMC, right? AMC is gone. What happened to Beyond Meat, right? Remember when Beyond Meat was one of those? Where's that energy, right? So Open is kind of one of the newer ones. At least it happened last year. Supposedly they are incorporating AI into their business. Opendoor is a house flipping business funded by hedge funds. They try to position themselves as an AI company. They're not. There's nothing. I mean, they have razor thin margins. They have failed during one of the most bullish housing markets. They were not profitable. They haven't been, and they just aren't, right? If we pull up Open, don't get me wrong. If you want to invest in Open, I encourage you to put money behind it if that's truly what you believe in. And some people think it's going to go to $82 per share. That's the story. That's the dream that is sold with this. I don't know what to tell you. It's not growing. It hasn't been, and it isn't. It lost $1.3 billion last year. And I get it. They offloaded a bunch of their inventory, which they still took into consideration with their revenue, even though they reported a huge loss on it. But nonetheless, I don't believe in it. I do believe in the hype. I think any stock can get aggressively manipulated. So I do think that it could run up for short periods of time just to crash back down. It's a pump and dump. That's always how I've seen it, always have, and always will. That's what these failing businesses are. They depend on the cult-like following to buy and hold, to go against short sellers, because so many people do target companies like this because they have and are failing. So again, just because I don't believe in it doesn't mean that you shouldn't. Shorting does not come at shorting is not something that is ideal for beginners. So in the best way possible, it's better to just not even short it, just let it be, right? It does come at a greater form of risk when it comes down to shorting, but yeah, Open broke a record for their highest loss in a year, 2025. Yeah, and again, I do poke a lot of fun on them. I'm trying to do a better job of not being as petty to people that like just really don't understand the market very well. So I kind of just feel bad for them. For most of them, not all of them. Some of them are pretty delusional. But when a stock is up what it was within a very short period of time, it's just so sad to see that people are still bag holding from like $7, $8, $9 per share, and they've wiped 30, 40, 50% of their accounts. But again, to each their own. And that's kind of the question that I wanted to ask you guys is, at what point would you consider cutting losses? At what point does it get considered bag holding? Is it when you lose 20%, when you lose 30, when you lose 40, 50, 60? At that point, like where is that line driven or drawn? I think that's the question to kind of ask yourself as you hold the losing position that's lost volume, losing momentum with falling price action. You know, it's just tough. Did the rate decision come out? Yeah, we've been talking for some time. So yeah, the press conference is about to start. Let me pull it up for you guys, okay? 1 second. So here we go. Again, I do want to remind you for all those that are tuning on in, we have about 1,900 of you. Again, if it's not too much to ask, hopefully you can drop a thumbs up. We're going to be watching Jerome Powell go live and answer analyst questions. If you like the software that we use today, which is this from Investing Pro, I mainly use it on this side, which is under their ideas or watch list. They have so much more to offer. Again, I would encourage you to just check it out. They have a huge sale going on right now. It's 55% off. It is an affiliate link. I want to be open with you guys. But I use this software every day. If you've ever tuned on into my live sessions, it's always what I use. And it is a current sale they have going on, and it breaks down to less than $9 a month. So a simple question I like to encourage you to ask yourself is having access to that software worth $9 a month for you? If it is, great. You can join. First link down below. If not, no hard feelings, right? My job is just to make you aware. All right, here we go. FOMC press conference. Let's host it. You guys ready? I'll shut up now. Okay. We're just waiting for this thing to start. Okay. Should be any second now. Here it goes. JP is live. Hope that you guys enjoy.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Here we go.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, First, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut, and each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction to your point, if we have high, if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement, and you also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually, and it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick.
Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So. And so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services.
Watch for a lower high on MSTR.
We do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services.
Watch for the break of support.
Seeing
another leg down coming.
Goods inflation come back down because the one-time effects of tariffs are through, and then
lower
also
highs,
get some
lower
help
lows.
from
Be careful.
non-housing services. That's what we'd like to see, but it's a good question why we didn't see much of that last year.
I don't trade options.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%. That amount, whatever it is. 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. You know, we need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent would you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together.
NASDAQ market dropping.
The January report was a positive
lower
surprise,
lows,
and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got
there we go, broke $6,000 on the day, going on MSTZ long, while MSTR drops. Good day.
At risk, and it's not.
Remember to take profits when it makes sense to you. Don't hold for other people to tell you when to sell. Have a stop loss or take profits when it makes sense to you. No excuses, okay?
It's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the 2 parts of our mandate. But, you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing, that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than
watch for new lows,
watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, meeting, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how.
All right, so there's going to be still a few more minutes of these questions. I think it's another 15 minutes, but we've been live for about an hour, so I just want to kind of wrap up. And again, if you want to continue to watch this, you guys can look up FOMC press conference. So let's just recap very, very quickly. First off, markets are selling off, but they're not doing anything different. Again, they're not doing anything different than what they have been the past few weeks. I know I'm going to sound like a broken record, but my LPP team, I can see them on Discord. A lot of them are celebrating that the markets are selling off. Cool. Again, I'm happy to be in the green. Trust me, I'm very happy to be up $6,000 like you guys saw. Let's not get it twisted, right? Markets have been consolidating nonstop, especially recently. QQQ, look at it. QQQ or look at SPY, which are overall indices, right? Common support, right around 595 is a common support range. We're right around 597. Again, they're general ranges. Yeah, maybe it could go lower. Maybe it doesn't have to. They're general oversold ranges. Common resistance range, right around 610. Kind of where we got rejected and definitely where we've been rejected multiple times before. The reason I say this is that I just want you to understand on the larger picture, the overbought and oversold levels. So although on the day, you might be feeling the pressure, right? Like we're all here for the same reason. It's to make money. Although you might be feeling the pressure today, and it might still sell off for the remainder of the week. I don't know, right? I want you to understand the bigger picture. The reason we talk about overbought and oversold levels is hopefully to encourage you to make more informed decisions on when to go long and when to take profits, or when to open up short and when to take profits. No one really should be complaining about what's going on right now because it's nothing new. It's not like markets are making new highs or markets are making new lows. We're all pretty much just trading within range. So again, we're all here for the same reason. It's to make money. If you got caught on a bad trade, unfortunately, that's your fault. Look back on your trade, look at those larger time frames and ask yourself what you could have done better. You can't predict, but you can always prepare. And that's, again, just hopefully words of encouragement that encourage you to just be a little bit more intentional and hopefully more calculated with the next trades you choose to take. Okay? So just like maybe some people are celebrating the market pulling back a little bit, because that's what I want to call it, a pullback, not a sell-off. Who knows? Trump can send out a tweet by the end of the day calling out Jerome Powell, saying that the war is over, and we return back to $6.10 per share. The money that you are up right now is not yours until you take profits. Have a healthy habit of either having a stop loss or just trimming your position when you are approaching a either support range or resistance range, depending if you're going long or short. Again, I want to see you guys all win, but I want to see you win because you earn it, not because you feel like you deserve it. You deserve nothing. You know who feels like they deserve everything? Bag holders. And what happens to bag holders every single time? They get slaughtered. How do you not become a bag holder? You don't hope for a green day. You prepare for it. And yeah, loss might be a part of it, right? Your job is to manage risk. Your job is not to avoid it. That's why we keep losses small and hopefully take profits when you are in the green. Again, these risk to reward ratios and concepts that we're talking about right now are all things that we cover in the LPP lesson library. A reminder, you don't have to join. You can learn how to trade on your own. You can watch a bunch of videos on YouTube. I have over 5,000 videos. But if you're someone that kind of feels lost and you want more structure, that's the whole point of this, is to offer structure with the lesson library, the daily live trading session, and the private group chat. It's all included. It's a one-time payment for lifetime access. It's the second link in the description down below, and it's discounted right now. On top of that, if you want the trading software that we showed you, where again, it allows you to dive a little bit deeper into the companies that you're thinking about investing or trading, it's Investing Pro, and they have a sale going on right now. And that's the first link in the description down below. You have a few hours left. So again, I appreciate you guys' time. I hope that it earned your thumbs up. Please consider subscribing. And like always, let's make sure that we end the year on a green note. Take care, team.